Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to another episode of Honest Money. We've been nagging one of our favorite guests to rejoin us, Rupert Hare, who is head of multi-asset at Prescient Investment Management. Rupert, thanks so much for joining us.
Yeah, thanks, Warren. Thanks to all the listeners and our viewers for dialing in as well.
So the reason that we like having you on the show is that you take these complicated concepts, which often can sound like Greek to a lot of people, and you make it quite simple for someone like me to understand, which I appreciate. So today we're taking a bit of a complicated topic, and it's around this whole debate around active versus passive, or active versus index investing. And I think maybe, to kick off, we need to just talk about what those are, because those are just my jargon radar is just flashing now, going, why are we throwing jargon at people? But I think it is worth talking about, and so maybe we need to just discuss that and what those terms are, and then maybe why do we care? Why is it important?
Yeah, no, great introduction. So I think something that's evolved over the years, let's just go back in South Africa in particular, go back to the origins of asset management. We had active managers, by definition, people that pick stocks, and the aggregation of active managers gives you this index. So in essence, you have, let's say, 20 different active managers, one's buying, one's selling a certain stock, market cap of that stock goes up or down. And then what in general passive indices are is simply the market cap weighted exposures of different underlying stocks. The difference being that active managers are looking to print what's called alpha, so outperformance over that passive benchmark. And the key in general, and we'll go into this in a bit more detail, but in general, active managers will charge you higher fees. And the reason for that is that they're going to be on the road, they're going to be going out to meet the CEO of Pick and Pay or whatever it might be to get insight. Well, I can't say inside information, but insights into the underlying companies, right? And the idea there is that they're going to either have a little bit more or a little bit less or none of a particular company, and they're looking to give you outperformance by doing so. So keeping in mind there's a higher fee in general for those active funds. That was the start of asset management essentially in South Africa in its current form of pure asset management. And then came along the indices, which is the aggregation of these active funds and underlying picks, which were packaged into what's called passive funds. So passive funds, they look to simply give you the weighted benchmark of those underlying indices. So the all-share index, it'll give you whatever the weight is to Naspers, Pick and Pay, Steinhoff, whatever it might be. They don't try and pick stocks. And the reason for that is essentially fees, right? Because those passive funds, they don't have to go on the road. They don't have to go and pick stocks. They don't have to do insights to different underlying companies. They're simply trying to provide you with a product at a very, very low fee solution.
So then maybe to my kind of throwaway question, but why do we care? Why would someone want to know that those differences?
Yeah, so I guess one of the biggest problems at the moment is that you're approaching the industry, which is very much evolved from the 80s and 90s when there were very few managers to pick from. Now, for instance, if you look at high equity as a category, which is perhaps the most popular, so multi-asset high equity funds, there are, at last count, I think it was 215 funds. Oh. So the big question that's existed over the last 10, 15 years, and this is a global question, is how do we pick one out of those, or let's say 5 out of those 200 plus managers? And then B, is it worth picking those active funds to try and get a little bit more than the average performance of underlying managers? Or should you rather go for the low cost solution and just use that as an anchor in a portfolio? And the question that's always up for debate is it actually worth picking active funds? And spoiler alert, in South Africa, more often than not, it's not. And I say that with a disclaimer in that there are a lot of active managers who do deliver alpha, but the fees simply just don't justify picking those active managers. They actually do make alpha, so outperformance of the benchmark, but essentially you're paying a lot of it away in the fees that you give to that manager.
Okay, so we've got, just for kind of my very simplistic summary of this, we've got fund managers from years ago who who would typically pay big research teams, internal research teams, and external stockbroker research teams, and they would all go out and kick the tires of every business and every bond and every property they own, and get an understanding as much as they possibly could of how those businesses work, whether those companies their share prices are cheap or expensive, and therefore whether the fund managers should buy those businesses or avoid them, or maybe blend them into other kind of portfolios of assets. And over time, that was kind of the whole industry. And in the early days, I mean, I grew up in this industry in the 1990s. Active managers charged massive fees, had huge marketing budgets, paid for lots of incentive trips for agents and brokers to go overseas, and the clients were the ones that weren't benefiting as much as they should. So I guess the industry evolves to the point where fees become a massive focus, and then the rise of these index trackers. And I think I mean, just doing some research before the podcast, if you look at the history of active managers and their outperformance of an index, it works out, from the research I've seen, it's sort of 1 or 2 out of 10 active managers get it right to beat the index, and so that is that's not a very high success rate, especially because it's not always the same 1 or 2 managers every year, year after year after year. And for me, if I were to answer that question about why do we care, I think the reason we care is that that outperformance by those 1 or 2 managers out of 10 is really significant. Those managers that do get it right to beat the index, and especially over long periods of time, their outperformance is quite significant. And for someone like me looking at this, I think that outperformance is too big to simply ignore. And so that maybe is the point here is if you don't have the time or the inclination, or you're a cynic about the industry, you might just go the passive route. But if you're looking, for a combination where you're saying, well, actually, I would like low fees, but at the same time, I would like to have the chance to get that one, to be in those 1 or 2 outperformers, then I think, active managers certainly have a role to play, and especially now that the fees have come down. I think, it's no secret that the fees, in the past were huge, and certainly the pressure's been on to drop those fees, and for active managers to justify why they charge those fees.
Yeah, I'm going to get to exactly that point now, just a comparison between us and the rest of the world. But just going back to your point on active managers, I think the biggest question for me, at least, or for other investors, should be how active are those active managers? Because going back to the 90s, they were very active. They would be like, the one would have 20% of this and the other wouldn't have it at all, because it was a smaller industry in terms of the assets chasing that alpha profile, and it was as such. It was a lot more justified to pick an active manager, and we've seen that through time. I mean, you mentioned sort of 2 out of 10 beating the benchmark. In those days, and in the 2000s, it was actually a lot more of them that beat the benchmarks. But the problem, in a way, was that those guys got bigger and bigger, and by getting bigger, you are concentrated or almost forced to hold different companies pretty close to the market cap of the underlying company. So basically, benchmark weighted in any case. Yeah. So then it comes out to the end of the day that you're paying, let's say, 2% TIC, so total investment charges, 2% for someone that's giving you the underlying, or very close to the underlying passive benchmark, which they call closet index trackers. So you mentioned the 2 out of 10. More often than not, those are guys that are taking proper active bets that can actually do so. And I think that's a space that is still very active in South Africa, in terms of there are managers out there who can do that. And you call them unicorns or whatever you want to call them, but they do exist. So I'm not saying that active is dead. I'm just saying that active isn't quite the active of the 1990s.
And maybe just to close on that point, I mean, I was still a youngster and very wet behind the ears in those days. But one thing was very obvious to me was there was a lot of insider trading in those days, and that was how some of those managers got that outperformance. Was lots of boozy lunches with management of companies, and the more the fund managers kind of watered the CEOs and the FDs, the more loose they became with their information. And I think, to the credit of the regulators and everybody else, the industry is now, I think, much tougher on things like that. And the ability for people to get away with inside information, I think, is incredibly small now. I think, it's an efficient industry, and research is quality research, not quality inside information.
Yeah, that's a good point. I think also the key in this information age is how fast that data comes out. So go back to the 90s again, and you literally had balance sheets, etc., which would come out in printed format, and you'd have analysts going through them and highlighting numbers and saying this doesn't quite look right, etc. So there definitely was value in that. But now, I mean, I sit on a Bloomberg terminal, and as soon as a company releases their financials, it comes out to me on the spot. So what you can do in this day and age is you can just build rules based on it. So I can say that I don't want companies with a certain EBITDA margin. I rule them all out in the space of a second, right? So that's another big shift that we've seen within the industry, and a lot of the active managers are embracing it. So they're saying, great, let's broaden our universe, let's make screens and filters so we don't have to focus or waste a lot of time on companies which really don't look good from the outset.
Okay. So now we're in a space where we need to ask kind of a hard question: is is it worthwhile paying active manager? Shouldn't we just kind of sit back and let the index do its thing and get the be number 7 out of 10 all the time?
Yeah, so I think 2 points to that. So we talk about the index doing its thing. By definition, if you buy a passive fund, you're going to underperform the index by the amount of fees that you're paying, right? So you're going to get the index less your fees, which a lot of people are very comfortable with. But you have to have made that overall investment decision to buy SA equities in the first place, right? So that in itself is a choice. How much equities do you have? How much bonds do you have, etc. And that's something which I think faces a lot of investors at the moment. But just talking towards fees, I think that's a very, very important point in this discussion. In South Africa, and this is quite an interesting survey from S&P that I focus on quite a lot. In South Africa, again, in multi-asset high equity, if we compare ourselves to the offshore markets, so the United States and the UK, we are currently having, this is amongst active managers, an average fee load of the management fee alone of 1.3%. In the UK, it's somewhere in the region of 80 basis points, and in the US, it's 60 basis points.
So maybe just sorry to interrupt you there for a second. So 1.3% a year, 0.8% a year, and 0.3.
Yeah, exactly. Yeah. So significant differences between us and other offshore economies or markets. And the question that I think always comes to mind is why? So how can our active managers still charge such high fees when, as you quoted earlier, let's say 2 out of 10 of them actually beat the benchmark? So I think that's going to be a significant pressure over the next couple of years. And it has been for quite a while now on the active guys and the passive guys to reduce their fees, because you just can't warrant, let's say in the 90s, you could perhaps have created 5-10% alpha and you're paying, let's say, 1% of that away. That's kind of warranted given the amount of groundwork that was done. And now you aren't necessarily getting that outperformance. So a lot of people are A, hugging that benchmark, but B, still charging that high fee load. So there's two things which definitely contradict each other in our industry at the moment.
And so do we? I mean, if I'm sitting here listening to this podcast, I'm taking away from this that it is more complicated. It's not so simple, and secondly that there is still a possibility that if at the very least I want exposure to active managers, I might actually get some performance above the index.
Yeah, sure. I mean, you can definitely screen or have a look out for active managers who have constantly delivered that alpha profile, and there are some of them, and also active managers that charge lower fees, because there are also some of them that are front running the market in a way and saying, listen, we can't justify charging such high fees. In fact, it doesn't work out in our favor because you then get negative alpha or underperformance of the benchmark simply by paying away fees. So they're in essence ahead of the game when it comes to fees. So those two things, combine the two, consistent performance and relatively low fee load, and you're at a pretty good starting point amongst active managers.
So maybe just a little bit of nuts and bolts. When you say consistent performance, we are, if I'm looking at those returns, am I looking at over what sort of time frame does it become realistic to say, okay, this is consistent?
Right.
To me, a year is a waste of time. So anyone can be number one or at the bottom of the ranking over a year, but where do we say, okay, now they're actually delivering? Now this is a team worth watching.
Yeah. So I think the answer to that is there isn't an answer, but if you can look at as many periods as possible, try and match that to your own horizon. So let's give you an example on this one. Let's say you have a 1-year horizon for whatever reason it might be, and for whatever, probably the wrong reason, you're picking a more higher risk equity manager. Now, an equity manager that makes 20% in one year and then loses 20% in the next, of which, I mean, there are quite a few of them, right?
Yeah.
And that's their game. That's not what they're not trying to, they don't do it by mistake. That's by design how the product works. But if you go in at the period when it's up 20% and then in a year's time it's down 20%, you've lost a lot of money simply by the unfortunate reason that you've mistimed the market. And I don't believe in market timing. I think it's impossible to market time like that. So rather focus on the type of underlying product that you're investing in, than trying to time in and out of the manager. My point being that if you're looking at a manager, look at the 1 year, look at the 5 year, look at the 10 year. They're always going to show you the thing that looks best, that shows them in the best light, as one does. We will often, and I won't deny it, in this industry, we do package things in the best way we can. But if you're doing a little bit deeper due diligence, try and look at all the different periods to give a better idea and understanding of how the manager performs in periods of stress, on an ongoing basis, all those sorts of things.
So it's. I mean, in the books that I've written, in the podcasts we've done, I've always said I feel that this is not an either or debate. I think that the index providers love to kind of stir up controversy and say, you should only be in index and you should only be passive, and then the active managers get upset and say, the index guys are all wasting time. And to me, the industry is broad enough, and there is enough scope globally, not just in SA, where you should look at, if it's me as a private individual, I would look at a combination. I think there are too many opportunities to be too specific. But the one thing for me that I always think about is with a good active manager in the space in which you operate. So back to your comfort levels around multi-assets. And for me, that's maybe where I take the most comfort from an active manager, is the ability to go, well, I might not be able to pick every great share and I might not be able to pick every great bond, but I can more consistently say, I think bonds are offering a bit better value now, and I think shares maybe less value, et cetera, and moving that the kind of mix of assets in a portfolio more aggressively than I could do it on my own as an individual investor, and then equally. I think now that regulations 2028 has changed, where balanced funds can have a bigger allocation offshore. I think that's a really tough decision for a private investor to make, is how much to send offshore, when, and I think in those kind of, you were saying high equity. So just for most people out there, we're talking about, the funds that are generally called balanced funds. So they've got a large allocation to shares. And now all of a sudden, someone like Rupert and his team can go, well, we're going to buy South African shares, American bonds, British cash, and move around. I'm not saying he's doing that, so I'm not putting words in your mouth, Rupert. But it's those decisions where someone like me would just spend hours and hours just worrying about the rand dollar and missing the asset prices. And I feel like maybe that's the advantage. I'm not convinced that someone who only buys shares, an equity only fund manager in South Africa, is going to deliver massive returns above the benchmark for the next decade. I think our market's so small. But the moment you go into that mix of assets where you can buy a whole bunch of assets, I'm much more convinced there that a manager can deliver better returns than someone who just statically buys, cash, bonds, property, shares and forgets about it.
Yeah. So I mean, spot on. So what we look into is the amount of variance, in other words, the amount of movement in your portfolios that can be explained by two things. The one is stock picking, and the second is the asset allocations. And the lion's share of that comes from asset allocations. So it's saying, as you said, how much equity versus how much bonds do you have in the portfolio? That's the real decision that needs to be made, especially for someone who's at different stages of their life cycle. That's the toughest part of this industry. So for us, we focus the majority of our time on that. That's where we believe that we can add alpha. We don't pick stocks at Prescient. So I have to just add Prescient into the mix at all times. We don't pick stocks here.
That's your one pitch, your one pitch per show.
because of that difficulty in making alpha, right? It's so difficult that we just don't believe that we at least have that 2 out of 10 ability to pick significant alpha generative stocks. But what we do believe, and this is a general statement, not just Prescient, is that you can make significant alpha within the fixed income market. So there you're looking to beat essentially cash, or be it shorter duration bonds, whatever it might be. You have a lot more certainty, especially in South Africa, to beat that underlying benchmark. So whilst we aren't active in the underlying stock picks, We are active in the asset allocations that we choose, so how much stocks and how many bonds that we put in our portfolio. And then we are also active in which types of bonds we put in the portfolio, because those two things we think are much more certain in terms of alpha generative abilities within the industry. And that in essence is a mix of active and passive. And I think this comes back to your earlier point. They aren't mutually exclusive in any way. I mean, I mentioned earlier that the active guys have got a lot of overlap with the passives because they have, some of them become more closet index trackers, as we call them. They're very similar to the passive funds. Likewise, within the passive funds, you are still paying away fees. And the second thing which always fascinates me in passive funds is, especially within multi-asset, where let's say you get a mix of 60% stocks, 40% bonds, right? For a passive fund, because they want to keep your costs low, they'll rebalance that twice a year. Most of them, right?
Yeah.
So in the 6 months in between those rebalances, your portfolios can diverge quite significantly. And they do that to keep your TIC, your overall costs low, because trading costs you money. Whereas the active funds, they trade a lot more actively by definition. So they will have higher TICs, so total investment charges, because they are looking to trade more frequently than passive funds. So just be aware of those two different dynamics, that passive funds in general can have a bit of drift away from what you think is on the label.
And they do, the bigger funds, those bigger passive funds tend to trade a little bit more frequently, whereas the smaller ones will then rebalance less frequently. So you'll find, the bigger guys now will be, I think they end up rebalancing once a quarter, just because of this ability. I remember watching them, with when Naspers was booming. And it would need to be X% of the fund, and suddenly it was X plus 3%, and that was freaking everyone out, because now you've overexposed to one share.
Yeah.
And again, the active managers would be staying, quite vocal there to say, well, that's, now you've got real single company risk. And in converse, you'd have other active managers saying, you don't have enough exposure to Naspers, we're buying even more. And that's the beauty of the industry, is it does give you a lot of opportunities for diversity of approach, and therefore there are some risks to that. But I do think it's an important thing to understand for investors, that we need to focus. I think you've mentioned it quite a few times, and I think it's worth reiterating again. When you're looking at fees, you're not just looking at an annual management fee. You're looking at the total investment charge, which is the annual management fee plus the auditing fees and all that stuff, plus the brokerage charges, the transaction fees inside that fund. And I think, some fund managers just drive, even the passive managers, I've seen a few where they really broadcast their annual management fee, but they really hide their TIC. And I suspect it's because they own their own stockbrokers, and then all of a sudden they're drilling their clients with lots of transaction charges, and it's hidden. And that, so be careful that not all passive is low cost. And I think it's a point to, there are lots of product providers out there who are very clever marketing machines, not necessarily out there to kind of generate the best return for clients. And I think be careful there. TIC is a golden number to focus on.
Yeah, definitely. I think that it's something that a lot of broad-based investors don't look at, but it's very, very important to get through that point, that it can cost you quite a significant amount to get the exposure that you think you're getting. And just on that point, going back to my earlier point of the management fees across geographies, so South Africa, the United Kingdom, and the US, why might that be? And this is one of my theories, at least. One reason is that in the US and the UK, you generally make lower overall returns because you've got lower inflation. So let's say you make 5% annualized. For them, that's quite a good return, right? But you can't charge 2% on 5% because almost all of your annualized returns. Yeah. So that kind of like, there was a filter or pressure on those managers to reduce those fee loads. In South Africa, for a very long time, we've had quite high inflation, which means that a lot of managers can charge, let's say 2% when they're making you 12%, because to an investor, they're saying, oh, that's not that much really. But it is actually a significant amount of fees. And to me, I obsess about fees, and I focus on that very, very often. And I think that it's something which is going to change in South Africa as the return profiles do decrease. Inflation in general is going to, structurally, they're looking to decrease it with the central bank. And if that does happen, there's going to be more and more pressure on underlying fees in South Africa.
Rupert, we've blown through our time by not hours, but lots of minutes. So I just wanted to wrap it up there. I think it's a great closing point, and just to thank you very much for your time. It's, as always, I'm learning, and thank you for sharing your knowledge.
Yeah, thanks to Warren, and thanks to all the listeners for dialing in. Again, it's always a pleasure.
Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.